Welcome to the Deep Dive, where we cut through the noise to get you well informed quickly. Today, we're looking at a really interesting situation, a bit of a contradiction, actually, from a recent earnings report. We've got a company that beat expectations, but then saw its stock take a pretty surprising hit. We're diving into the third quarter 2025 results for Deere Company, released August 14th, 2025. So what actually happened? Why did the market react like that? And maybe more importantly, what's the forward guidance telling us? Let's unpack it. Okay, so on the surface, Deere's Q3 results looked quite strong, right? They reported net income of $1.289 billion. Now, that was down 26% from last year, but here's the kicker. Their diluted earnings per share, EPS, came in at $4.75. That actually beat the forecast of $4.58. Revenue also came in higher than expected, $10.6 billion versus $10.35 billion anticipated, although overall net sales and revenues were down 9% year over year. So despite these beats, get this, Deere's stock just tanked. It plummeted by almost 8%, 7.95% pre-market trading. That's a big disconnect.
It absolutely is. And that immediate market reaction is what's fascinating. While the company delivered, solid results for the quarter operationally, the market seemed to be looking past those numbers straight into the future, really. For instance, Investing Pro analysis highlighted that the stock already seemed, overvalued compared to its calculated fair value. So you combine that valuation concern with growing worries about the sector, broader market caution, and it just seemed to overshadow the quarterly performance itself. It really shows how investors today are maybe focusing more on let's call it the future story of a company, the outlook, the growth path, not just looking in the rearview mirror at past results. And, it's worth remembering Deere has this incredibly strong history, right? 55 straight years of dividend payments. They offer a 1.26% yield right now, which speaks volumes about long-term stability. But even that wasn't enough to calm the nerves this time around.
Yeah, that difference between the now and the next is crucial here. So if the numbers looked okay, but the stock fell off a cliff, it tells you something deeper is going on. Let's dig into the specifics then. How did the different parts of the company actually perform? What were those underlying issues? Let's start with production and precision ag. That's the big one for them, right? Well, net sales there dropped pretty significantly, 16%, down to $4.273 billion. And operating profit basically cut in half, down 50% to $580 million. So they said the main reasons were lower shipment volumes and this thing called unfavorable price realization.
Right, and that unfavorable price realization point is really critical. It was largely because of what Deere calls increased pool funds. Now, you should think of pool funds as, it's basically money Deere sets aside, money to help its dealers move used equipment off their lots. It's a kind of incentive because, when interest rates are high and demand is maybe slowing down, used machines can just pile up, and that makes it harder to sell the new stuff. So Deere is essentially spending more, taking a bit of a profit hit short term to help subsidize those used sales or offer deals to keep inventory moving. It shows a strategic choice, right? Focus on clearing inventory, holding on to market share, even if profit dips for a bit. This kind of disciplined execution is key. And it's why we saw those big inventory reductions across the board year over year, like North American big tractors, the 220 plus horsepower ones, inventories down 45%, combines down 25%. And in Brazil, large tractor and combine inventories are down over 50% from where they peaked in late 2023. That's huge. They've also been pretty smart with their financing tools, like that split rate financing from John Deere Financial. That's where dealers can actually buy down the interest rate for the first few years of a loan, just making it easier for farmers to buy, especially when borrowing costs are so high.
That's a really good point about controlling what you can control, even if it hurts the immediate profit number. What about the other parts of the business? Small ag and turf. Sales there were down just a little bit, 1% to about $3 billion. Operating profit dipped slightly to 2% to $485 million. Lower shipments again, but they got some help from currency exchange rates and some price realization. But higher tariffs were mentioned as a factor hurting profits there too. Then you've got construction and forestry. Sales down 5% to around $3.1 billion. But look at the operating profit, a massive 47% drop, down to $237 million. That's a huge hit. It really suggests that in North America, particularly with earth-moving equipment, Deere is facing some really tough competition, maybe having to cut prices just to sell machines. And on top of that, those rising tariff costs are clearly hitting their bottom line hard in that segment.
You absolutely nailed a critical factor there, tariffs. That really jumped out in the report. The company said tariff costs just in Q3 were about $200 million, which brought their total costs for the year so far to a staggering $300 million. And get this, they've now upped their forecast for the full year impact of tariffs pre-tax to nearly $600 million. That is a massive increase. And it's mostly driven by higher rates on stuff coming in from Europe and India, plus steel and aluminum tariffs. So this is a major headwind for their margins, makes it much harder to stay profitable. Even though they are trying to push through some price increases in other areas to offset these costs for future quarters, it's a direct hit from, the global trade situation, something they're really wrestling with. The only real bright spot financially was financial services. The net income actually rose 34% to $205 million, mainly because they didn't have to set aside as much money for potential bad loans. Fewer loans went sour than expected, which is, well, it's a good sign about the quality of the loans they're making.
Okay, so we got this picture emerging, right? A company facing serious external pressures, tariffs, competition, but also being very deliberate, very strategic about managing inventory. Which brings us naturally to the road ahead. What's Deere's forward guidance look like? Well, they gave full-year net income guidance of $4.75 billion to $5.25 billion. That's a slightly tighter range than before. And that partly reflects those ongoing tariff impacts we just talked about. Cash flow from the equipment side is expected between $4.5 billion and $5.5 billion. Now, looking at the industry outlook they provided, it's definitely a mixed bag. For ag and turf in the U.S. and Canada, large ag sales are still expected to be down significantly, around 30% for the fiscal year, pressured by, well, usual suspects, high interest rates, lots of used equipment still out there, trade uncertainty. Small ag and turf in the U.S. and Canada, projected down 10%. But there's some okay spots elsewhere. Euro ag is seen as flat to down maybe 5%. South America ag flat. And Asia ag could actually be flat to up 5%, mainly thanks to a better market in India.
Yeah, if you step back and listen to what management was saying, their commentary sounds conservative, but also resilient. The CFO, Josh Jepson, put it nicely. He said something like, "We've managed downturns and trade uncertainty before. That's part of our DNA." And their core strategy going into fiscal year 2026 is this: build in line with retail demand across all the businesses. What that really means is they plan to match their factory output almost exactly to what dealers are actually selling to customers. Now, that's a big shift from this year where they were deliberately underproducing by about 10% in small ag and turf and construction and forestry. They did that intentionally to help clear out all that built up inventory. So this shift to building exactly what's being sold could actually be a pretty significant tailwind for their production levels next year because they won't be actively holding back manufacturing anymore to draw down inventory.
And for construction and forestry, the outlook isn't totally gloomy either, right? U.S. and Canada construction equipment expected down around 10%. Contact construction is flatter, maybe flat to down 5%. Global forestry and road building are mostly flat or just slightly down. It really feels like they're adjusting their production dials very carefully, almost waiting for the market to give a clearer signal.
Exactly. And this brings up something really important. Those early order programs, or EOPs, for the 2026 models. That's basically when farmers and contractors place orders way in advance for next year's machines. Now, for sprayers, that EOP window just closed, and orders are projected to be down roughly 20% compared to last year. But management was quick to caution, don't read too much into just the sprayer number. They're on a different replacement cycle, apparently. The EOPs for planters and combines are still very early days. What is significant, though, is the pricing for these 2026 models. For products going into these EOPs, the announced list price increases are between 2% and 4%, and large tractor pricing for 2026 is up about 3% year over year. Now, this is clearly intended to help offset those rising tariff costs we discussed, costs that were really hard for them to price in for the 2025 models because those orders were already booked before the tariffs hit so hard. The company does say they see some green shoots in order activity, little signs of life. Particularly in North American earthmoving, which could be getting a boost from infrastructure spending and maybe bonus depreciation rules, that tax break that lets businesses write off more of an asset's cost up front, making big purchases more attractive. So ultimately, yeah, they acknowledge the market's uncertain, but Deere is definitely positioning itself to ramp up quickly when demand does eventually come back.
Okay, moving beyond the immediate financials and the outlook, it's actually really fascinating to see where Deere is putting its money for the future. They gave updates on several advanced technologies and solutions, things that really paint a picture of long-term strategy. Take JD Link Boost. That's their satellite connectivity solution, designed for places without good cell service, right? Like, think about Brazil. 70% of the farmland there lacks reliable cell coverage. In just its first year, they've already gotten over 5,000 orders globally. Big interest in North America, Australia, New Zealand, too. That's a huge deal for keeping machines connected, getting data flowing, no matter how remote the field is.
And what's really compelling about this tech stuff is how it's not just, one-off cool gadgets. These innovations are scaling across completely different types of work, like the John Deere Operations Center, that digital platform. It was initially a massive success in large-scale farming, but now they're using it really effectively for road building projects, too. They've actually more than doubled the number of active organizations using the Op Center for road building, up to nearly 3,000 this year. That shows real flexibility in their tech platform and a clear plan to grow that digital ecosystem way beyond just traditional agriculture.
Exactly. And then there's Precision Essentials. That's like a starter pack of their core precision tech since launching last year. 21,000 global orders. And it's really driving engagement with the Operations Center. It's brought over 2,400 totally new customers into the Op Center ecosystem. And folks already using it are seeing a big jump, 35% increase in what they call engaged acres, and nearly 50% more highly engaged acres. Now, engaged acres basically means farmland where the customer is actively using data and precision tech. Highly engaged means they're really maxing it out. Overall, Deere has blown past 485 million engaged acres globally. That's incredible scale. And the in-season results for their See and Spray technology, also looking good. Machines from the 2024 group are running that tech on 30% more acres this year. Remember, that's the system using cameras and AI to spot individual weeds and spray only them. Huge savings on chemicals. And they're also seeing big results from new precision harvesting features. Customers are reporting over 30% more throughput, that's bushels per hour, and over 20% better machine productivity acres per hour, just by using automated settings and predictive ground speed. These are real dollars and cents benefits for the farmer.
Which brings up, I think, an important question about the whole strategy underneath all this. Deere is clearly laser-focused on delivering solutions that create, quote, meaningful outcomes for their customers. Things that directly translate into lower costs, better productivity, higher yields, more profit, the whole package. The CEO, John May, he pointed out that making these positive impacts happen, even when the market's down like it is now, well, that actually accelerates adoption and utilization of these solutions as market dynamics improve. Basically, proving the tech's value now builds confidence and makes customers more likely to adopt it faster when things pick up, which in turn gives Deere further confidence in our ability to outpace historical performance. That's a big claim. And the integration of AI and machine learning, which is already baked into things like See and Spray, that's only going to enhance efficiency further as they analyze these huge data sets they're collecting. Think about the potential, optimizing everything from how densely you plant seeds to exactly how fast the harvester should move, all based on real-time data and smart predictions. It's really about creating a much smarter, much more efficient farm or construction site.
So let's recap. We've unpacked Deere's Q3 2025. We saw that surprising market reaction despite, pretty solid operational numbers. We dug into the details segment by segment, saw the big impact from tariffs, looked at their forward guidance, and saw this continued really robust investment in cutting-edge technology. It's definitely a complex picture, isn't it? A company navigating some pretty strong headwinds, definitely, but also very strategically building for the future, placing big bets on innovation.
Yeah, and if you connect it all back to the big picture, Deere's leadership kept hammering home their commitment to long-term value, emphasizing that DNA we talked about managing downturns by focusing hard on the things they can control, like disciplined cost management, keeping inventory levels in check. They're sweating the details. They truly seem to believe they are, quote, incredibly well positioned for future growth, despite all the global uncertainty swirling around. The company is actively getting ready for what they see as an eventual market inflection point, that moment when demand really starts to turn back up again, driven by things like, potentially strong crop yields, maybe some positive shifts in trade deals, hopefully, and also the growing demand for renewable fuels, which often uses agricultural feedstocks. So maybe this leaves us with an important question for you, the listener, to think about. Given this mix, we've discussed the short-term challenges like tariffs and competition, the proactive operational shifts they're making, and these really significant long-term tech investments. What do you think is going to be the single most significant factor driving John Deere's performance over the next few quarters and maybe even beyond? Will it be those external market forces finally turning positive again? Or will it be their own internal strategic execution and innovation that pushes them forward, regardless of the environment? Something to chew on.